Hi everyone, welcome to my channel. My name is Nogo Temba. If you are a returning subscriber, thank you so much guys, I really appreciate. If you are new here, you are more than welcome. Make yourself comfortable and feel at home.
Hello everyone, in today's session we are going to do the second tutorial on statement of changes and equity, which is going to be a little bit step up from the very first one I did. Okay, so let me not waste much of your time. Grab your pen, your paper and calculator. Come join me, let us do this together.
Here is the information provided for our tutorial. We have been required to prepare the statement of changes and equity for the year ended 31st December 2023. Write down your structure. Here we have ordinary share capital, we have preference share capital, we then have retained earnings and the total column. On the first section of this information, we have been provided with opening balances. Let us go and record our opening balances as they are given on the information. We began the year having ordinary share capital of 600,000. We have preference shares of 400,000 and retained earnings of 700,000. When you add them together, that gives us a total of 1,700,000. You record it down. We then move to the additional information. The very first information, we have been provided with the net profit after tax of 350,000. You take this 350,000 as it is, you record it here under your retained earnings. Okay, net profit only affects retained earnings, so under ordinary share capital and preference share capital you put a dash. So we have a total of 350,000. You then record it down. We then move on the next information. Here we are told on the 1st of January 2023, 200 ordinary shares were issued at 3 Rand per share. Okay, if you say 200,000 shares times 3 Rand gives us 600,000, which is the value of ordinary shares issued on the 1st of January 2023. You then record this 600,000 here under your ordinary share capital. This transaction continues and say 150,000 15% preference shares were issued at 2 Rand per share. Okay, we then do the same. We say 150,000 shares times 2 Rand each gives us 300,000, which is the value of preference shares issued on the 1st of January 2023. Okay, you then go and record this under your preference share capital as well, like this. So in this case, retained earnings are not affected. You just put a dash, then you say 600,000 plus 300,000 gives us 900,000, which is the total of these two. You take this 900,000, you record it here under the total column. You then move forward to the next information, which says share issue cost amounted to 5,000, of which 30% is related to preference shares. Okay, so this means 70% is for ordinary shares and 30% is for preference shares. Okay, let us do the calculation. Here we say 5,000 times 70% gives us 3,500. Alright, share issue cost for ordinary shares is 3,500. You record it here under your ordinary share capital. You then put brackets. Alright, again you repeat the same calculation. You say 5,000 times 30% equals to 1,500. This 1,500 is the share issue cost for preference shares. You go and record it under your preference share capital. Again, you put brackets. So dear friends, understand this. Share issue cost is always negative. So you need to put bracket whenever you are recording share issue cost. Okay, let us move on the next information, which says on 30 June 2023, The company authorized a share buyback of 50,000 ordinary shares at 150 per share from the shares that were issued in the previous year. Okay. Last year we issued 500,000 ordinary shares at 120 per share. Okay. Out of these 500,000 ordinary shares, we decided to buy back 50 ordinary shares.
So guys, if you are interested in seeing more videos like this in the future, please subscribe.
So we are going to say 50,000 ordinary shares times 120 per share. 120 is the original price we used when we were issuing these shares last year. Okay, so when you say 50,000 times 120, we get 60,000. 60,000 is the capital we raised in issue of these 50 shares. All right, so now we need to deduct 60,000 from our ordinary share capital because we are now buying back our shares, meaning 50,000 ordinary shares is no longer issued. So we need to remove it from our total issued shares. Let us continue. The buyback price is 150. When you say 150 minus 120, how much did you pay extra to buy back your shares? 150 minus 120 gives us 30 cents. Okay, so 50,000 ordinary shares times 30 cents equal to 15,000. 15,000 is the amount we paid extra to purchase back our shares. So this 15,000 decrease our equity. So you are going to record the 15,000 under your retained earnings and put brackets to indicate a decrease. Okay, let us move forward on the next information. At the directors meeting held on the 1st of November 2023, it was decided that to issue capitalization shares on the basis of 2 ordinary shares for every 5 ordinary shares already held by shareholders at R1 per share. Okay, so at this point we need to know how many shares do we have, like exactly number of shares do we have in issue so far. Okay, at the beginning of the year we had 500 ordinary shares. We then issued 200,000 ordinary shares. During the year we bought back 50,000 ordinary shares. So when you say 500,000 plus 200,000 minus 50,000 gives us 650,000 ordinary shares in issue. So as at 1 November 2023, we have 650,000 shares in issue. Okay, so we want to know how many shares are we going to issue for capitalization. Okay, remember the capitalization issue basis says 2 shares for every 5 shares already held. Okay, let us do that. We have 650 ordinary shares times 2 divided by 5 gives us 260,000 ordinary shares, which we are going to issue for capitalization at R1 per share. So when you say 260,000 ordinary shares times R1 per share gives us 260,000 share capital. Okay, so you take this 260,000, you record it here under your ordinary share capital. Okay, the twist here with capitalization issue, as a company we are the one paying for these shares, so it decreases our equity. You then just go straight on your retained earnings, record this 260,000 and put brackets to indicate a decrease. Okay, so now when you say 260,000 from your ordinary share capital minus 260,000 here on your retained earnings gives us a total of 0. Under the total column, you record 0. Okay, the next information says, in terms of a director's resolution, the directors declared dividends on the preference and ordinary shares on 30 December 2023. Okay, payable to shareholders registered on 30 July 2023. Okay, the dividends on the ordinary shares was 20 cents per share. The balance on the ordinary shares was issued at 3 Rand per share to finance payments of dividends. Okay, so this basically means we issued our remaining shares so that we can get funds and pay dividends. Okay, how many shares are we remained with? I guess we should find out. We have been authorized to issue 1 million ordinary shares. So when you say 500,000 plus 200,000 minus 50,000 plus 260,000 gives us 910,000. So far, we have issued 910,000 ordinary shares. Okay, so when you say 1 million minus 910,000, we are remained with 90,000 ordinary shares. So we are going to issue all of these 90,000 ordinary shares. Okay, so when you say 90,000 ordinary shares times 3 Rand per share, which gives us 270,000, which is our ordinary share capital raised in issue of the remaining shares. Okay, so you take this 270, record it here under your ordinary share capital. Preference shares are not affected. Retained earnings are not affected as well. This means under total column, we record 270,000. Okay, so now let us calculate preference dividends. At the beginning of the year, we have 400,000 plus 300,000 gives us 700,000. You then take this 700,000, multiply by the fixed rate of the preference shares of 15%. So 700 times 15% gives us 105,000, which is our preference dividends. You go record it under your retained earnings and put brackets. We then move forward and calculate ordinary dividends. Okay, ordinary dividends are payable on 30 July 2023, which is before the capitalization issue. So remember, before the capitalization issue, we had 650 ordinary shares. So you take these 650 ordinary shares times 20 cents per share, which gives us 130,000, which is our ordinary dividends. You record this here under your retained earnings. Also record this 130,000 here under your total column and put brackets. So what we need to do right now is to total each column so that we can be able to get the closing balances. Okay, so guys, you should be able to calculate your total equity horizontally or vertically. Both, they should give you the same amount if you have done your statement of changes in equity correctly. Thank you.